Assalamu alaikum. Hello and welcome to Gurukul Online Learning Network. Today I'm instructor Sheikh Mahadi. We're going to study finance and banking. Chapter 5, short-term and long-term finances. So in the previous lessons, we learned about a lot of reorder level, EOQ, ordering point, gross profit ratio, profit margin ratio, debt equity ratio, various kinds of things. But now we'll get to the calculation of the maximum stock level. So what's a maximum stock level? When an inventory drops the reorder level, an order is placed immediately. So what was a reorder level? A reorder level is when your supply stock is getting out of hand and you have a certain amount within your inventory, and that time that inventory is as calculated as much as could be. At that point, when you order those products again and the time it takes to reach to your hand, that certain point is called a reorder point. As in the previous math as we did, if you look at back our classes, few of the classes, you can definitely see that when a restaurant had 730 dozens of cups and that cup dropped to 8 dozens of cups, at that time they ordered more 730. That means a more 730 units, dozens of cups. At that time it took 4 days, the lead time. That when there were 8 dozens of cups that one day, that day they placed an order for 730. So 4 days would take for that 8 dozens of cups to get finished, and the 730 dozens of cups will arrive at the 4th day. So that's called a reorder level. So at that point a order is placed immediately. The quantity that is ordered at the time is called reorder quantity. So if quantity is most economic one, we call it economic order quantity. So what's an economic order quantity? Suppose your restaurant needed 730 or 750 cups in 6 months. In 6 months they needed that much cup. But if you increase more than that, the amount of order more than that, like you are taking up to 900 dozens, or that would be a huge wastage. Like suppose your 730 are done and most of the products or most of the cups will be just laying around wastedly. But if you order less than 730 or 50, you will, suppose you took an order of 600 or 650. In that process, you won't be able to give your customers as much as they want. That will be a huge irrationality of supply and demand. So that's called an economic order quantity. The amount that is needed, that amount has to be placed to an order. So maximum stock level indicates the level above which further no inventory can be possible. So using the maximum stock level calculation, we can easily figure out that we do not have to order any much more quantity than the given desire which has to be provided according to the supply and demand. We can easily evaluate the maximum stock level using our given formula. So maximum stock level formula is the reorder point. That means reorder point means we just explained. Reorder point is when the time we have to order that. The reorder quantity is the supply of units. How much units do we need? And the minus minimum lead time into usage. What's the minimum lead time? Minimum lead time, as said, when the cup dropped to 8 dozens, that means it's about to be over, and that time when we place an order and up to the time when the parcel is received at our hand, that much time or that much days is called the minimum lead time. Into usage is how much we want. That's called the usage. And simple. So let's take a look at an example. For an example, organization inventory has a reorder point of 30,000 units and its reorder quantity is 50,000. So reorder point is 30 and reorder quantity is 50,000. So let's write it down. 30,000 is the reorder point plus 50,000. 50,000 is the reorder quantity minus minimum lead time into usage. Our minimum lead time is given. Monthly usage would be 10,000. After placing order, it usually takes 2 to 3 months. So in that case, we'll take the minimum number. That means we'll take 2 months into, they said, the usage of 10,000 cups into minimum lead time would be 2 into usage of 10,000. 30,000 plus 50,000, that would raise up to 80,000. 80,000 minus 2 into 10,000, that would be 20,000. 80,000 minus 20, we will get 60,000, a whopping 60,000 units. 60,000 units of minimum stock level. So that is the most minimum stock level that has to be kept in stock for any kinds of future or troubles, orders or disadvantages, whatever it, or maybe even at a time of crisis. That's the maximum stock level we are going to keep of 60,000 units. So, secondly, let's see what's a cash turnover here. Cash turnover, 360 into conversion cycle. That's the basic formula. So let's talk about cash turnover. What's a cash turnover? Cash turnover indicates how many times in a year cash conversion cycle occurs. What's a cash conversion cycle? Cash conversion cycle works like, suppose inventory commission period plus receivable commission period, accounts payable conversion period. That's called, we'll take the calculations later on, but let's discuss that for example. So cash turnovers, that's basically that's the basic theme of cash turnover. The main formula of the cash turnover is 360 divided by the cash conversion cycle. How do we know what is our cash conversion cycle, the amount of the periods or the months? So let's take an example. Let's see. Desire company purchases a raw material credit purchased after 20 days. While selling finished product, it allows credit for 45 days. Inventory conversion day is 70. So receivable conversion day is 45. Receivable conversion days is 45 days. Accounts payable conversion period will be 20. Accounts conversion day will be 20 days. Account conversion period will be, and inventory conversion period will be 70. Inventory conversion days will be 70 days. Inventory receivable conversion day 45, accounts conversion 20 days, and inventory conversion of 70 days. So what will be the basic formula for that? Inventory conversion period plus receivable conversion period minus accounts payable conversion period. So that will be receivable plus accounts minus inventory conversion, RCI. That would be inventory conversion. Inventory conversion minus receivable conversion. Inventory conversion, receivable conversion. $70,000 plus $20,000. $70 plus 45 minus 20 days. That will be equal to our 90 days of cash conversion cycle. So as we figured out, our cash conversion cycle day is up to the maximum of only 95 days. We'll simply put it in our equation over here. It would be 360 divided by 95. Cash conversion cycle of 95 and 360, we will take it of a full year. 3.79. As it is more than 3.50, we will take it as simple as 4 times in a year. 4 times. So that's simple as that. Determination of optimum cash level. The next point. We'll just erase it. So determination of optimum cash level. Optimum cash level implies an idea amount of cash that a company wishes to hold in reserve at any given point. At any given point in a time. This model was developed by William Baumol. It's a person who has developed many of the few transactions of the accounting and the financial regions of the various kinds of books. The objective is to minimize the sum of fixed cost of any transaction and the opportunity cost of holding balances that do not yield a return. That means what kind of transactions are we talking about? Transactions that do not give us an output of any kind of profit or yield of a return. Holding cash balances that do not give us any kind of return, like return on investment, ROA, ROI, or ROC. So for any business organization, excess cash on hand might lead to missing out on investment opportunities, i.e. interest income, capital gains from other interests. So what does that mean? Holding out so much money or too much capital in hand could force us to in a loss of various kinds of profits. Like it can be lost in various kinds of opportunities. We're just keeping the cash in our hands. In that way, we cannot gain interest on capital or interest income or capital gain from other investments. So too much cash on hand is risky for various kinds of business purposes. That's why determination of cash level is very important in kinds of different sectors of financing. Also, a company has a very poor cash balance may often need to be forced to sell inventories or any other current assets at an undesirable price to get required cash for its operational activities. Why does that happen? Because people most usually, sometimes if they keep cash in hands and that is somehow diminished or dissolved, then they have, if they need extra money for that or their investment, they need to sell their assets or products or different kinds of shares for that to take excess capital into business, to take more cash balance. So we easily understand that equally bad to have too high and too less. It can be equal, like alternate, 1:1. Too much cash balance is good, bad, and too much less is also bad. Not too good, not too good, not too bad, not too well, not too desirably, arguably, or that could be the lower to the expectations. So secondly, that's why you need to strike a balance of optimum cash level brings in the level which is just right for any kinds of company. So optimum cash level is determined using the following equation. Optimum cash level, Q is equal to root over 2 into F into T divided by I. I'll write all the terms which these all stands for. Q, optimum cash level for borrowing or selling securities. Q is optimum for security. F indicates fixed cost of selling securities or obtaining loan. We'll just take it as fixed cost. Fixed cost of selling. Fixed cost of selling. T. T indicates total cash requirement, the total amount of cash required for the business or the investment or any kinds of total invest. So I'll just erase that Q. So T means total cash requirement or just total invest, just cash requirement would be good. Total cash requirement. I stands for interest rate opportunity, interest rate, or in short term opportunity for cash holdings. I is simple as everywhere. I is interest rate in every section. So I is equal to the interest rate. So let's take a look at an example of optimum cash level. Summit Company Limited estimates a cash requirement of maybe 2 million taka for a year. The opportunity interest is only 6% per annum. That means 6% every year. Transaction cost for borrowing that loan is 150. So 150 is our F, fixed of selling cost. The total investment would be 2 million. 2 is just on its side and I is equal to 0.06. So let's put that into equation. 2 into 2 million. 2 into 2 million F into T. How much was the T? It was a T and this is 150. The F. This is the F and this is the T. I is equal to 0.06. Multiply the upper line divided by the second and the root over of that will be 100,000. Students can easily just take it out on their own. It's nothing to be said. Secondly, we have the optimal cash average balance. What's the optimal cash average balance? It's the average that we just had in our optimum cash level. Averaging all the balances is one of the main factors in financing any kinds of math in our business terms. So optimum cash level is simply Q divided by 2. Our Q, earlier we got 100,000. So Q divided by 2 would be 100,000 divided by 2. That would stand us at 50,000. So with this maths, we are finally taken into our chapter 5 of short-term and medium finances. This is the end of the chapter. If you have any kinds of questions or any comments regarding this whole lesson, please let us know down in the comment boxes below. And thank you for being with Gurukul.